we're going to begin Module 4 of the Series 7. My favorite day, that's options. There's roughly 20 to 25 option questions on the Series 7. I know they are a big source of anxiety for a lot of you. However, I have a little mad method that I think you might find extremely helpful. As a matter of fact, the average score on options for the folks through my class is 80% or above. Good news, huh? As a matter of fact, many of you, once you get this little system, many of you will be hoping for Series 7 questions on the test. I bet you weren't expecting that. So let's take a look. First, the basic definitions, of course. You'll probably find these in all the textbooks. But, let's just take a look at this. I think most of us understand that options represent a contract between two sides, right? A buyer and a seller. And to be honest with you, I think that actually is the beginning of the source of anxiety for options. Because you start thinking about these contracts and one side or the other. But no, think of them instead as a stock or a bond. Right? They are a security that buyers and sellers trade on an exchange, just like stocks and bonds. Okay? Now, one of the early sources of anxiety for us is oftentimes a lot of the test questions don't use buy or sell, right? They might say the holder, or they might say an investor is long. Okay? They all mean the same thing. They just mean buy. Okay? Same thing with the seller, right? They might say sells, or writes, or short, right? And guess what? They all mean sell. That's it. So as your brain's trying to jump over, the theoretical concepts of the option contract, and they start throwing long and short and right and all that stuff. Okay? It just means buy or sell. That's all it means. Okay? There's no hidden meanings to any of these. It simply means buy or sell. Now, who knows where the origin of these terms come from, right? It's probably 100 years ago somewhere. Some trader. So anyway, now, so an investor will either buy an option or sell an option, just like stock. Okay? Now, watch this. Your investor buys one XYZ June 30 call at 2. Okay? When XYZ, the actual underlying stock, when XYZ stock is trading at $27 a share. Okay? Why? Why does our investor buy an XYZ June 30 call at 2? Now, I wonder how many of you are sitting there thinking, let's see, the right to buy, the obligation. Who cares about all that stuff? Okay? Most times in textbooks, they go through half a chapter explaining the rights and obligations to these option contracts, rather than simply the investor's market attitude. The rights and obligations to option contracts only matter if the contract is going to be exercised. Again, see, that's where all the anxiety comes from. Options very rarely are ever exercised. It actually defeats the purpose of options for most investors. Now, will you ever see an option exercised on the test? Yes, of course. How many times? Once? Twice? Maybe 3 times? I'd be surprised you see an option being exercised 3 times on this test. Okay? Probably a couple of times, and that's it. So we all get lost in the rights and the obligations when we forget the typical reasons why investors buy these options. There's really only 2 reasons people buy options, right? That's the big reason, is leverage. Think about this, right? Now, you're probably already I wrote that up there, and half of you are probably already saying the right to buy 100 shares, right? And, you know, and you start going down that path. Okay? I'll tell you what. I'll meet you kind of halfway there. It is a theoretical right to buy 100 shares of XYZ stock at $30 a share. Okay? Anytime between now and whatever the expiration month is. Okay? So it's the right to buy 100 shares of XYZ at 30. However, that's really not what this investor is attempting to do. They don't want to own the stock. Because think about that. 100 shares of XYZ at 30, that's $3,000. To hope the stock goes up. So in that case, you're betting $3,000 that the stock goes up if you buy 100 shares at 30. Now, check this out. How much did this option cost this investor? $200. And guess what? He thinks the stock's going to go up. So what would you do? What would you prefer, right? Paying $200 in hopes the stock go up, or paying $3,000 in hope the stock goes up? You see what I mean? That's where the leverage comes in. It allows us to profit from the stock going up, but by far, far less capital expenditure. It only costs us $200, okay? Now, also, that represents the market price of the option. I bet you most of you already know, right? We call that the premium. But how many of you think of it as a market price for a security? Because that's what it is. It is the market price for this option. And it constantly fluctuates in value, just like the price of any investment. Okay? Now, the price of an option, the premium, actually depends on two things. One is how much time we have for the underlying stock to go up or down or whatever we're hoping to do. Okay? The more time there is, the more valuable it is to us, and therefore the higher that premium would be. Okay? But what actually determines time value is a pretty complicated, sophisticated calculus formula. It's called the Black-Scholes model. You know, we don't need to go down there. There's actually an indirect way we can find time value a little bit later. Okay? So one of the things that affects the value, the price of an option, is time. Right? The more time there is, the more valuable. And what else do you know about time, right? Tick, 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 tick. Like grains of sand through an hourglass, so are the days of our lives, right? That time slowly, inevitably erodes away. So eventually, all options will have zero time value, right? Once they reach expiration, okay? So, we know that the price of the option, the premium, is going to fluctuate based on time. And it's also going to fluctuate based on the actual price of the underlying stock. Okay? And if the value of the underlying stock starts trading at a price relative to the strike price, either above or below it, then we have what's known as intrinsic value. Essentially meaning real value, right? Theoretically, if we have the right to buy 100 shares of XYZ at 30, right? Then with the stock at 27, there's really no value to that. But what if the stock goes up to 31, right? And you have this right to buy it at 30. Or if it goes up to 35 or 40 or 45. See, now the contract actually has what we call intrinsic value, real value. The traders refer to it as in the money. Okay? Now, caution. Here is the definition for intrinsic value for call options. When we get into put options, it's going to be different. Okay? The definition of intrinsic value, okay, for call options, intrinsic value, is when the market price of the stock, can we just call that CMV, sub S, okay? In other words, the market price of the stock. If the market price of the stock is greater than the strike price of the option, it's in the money. Okay? Caution, it has nothing to do with the original price we paid. It's simply, theoretically, once the price of the stock exceeds the strike price of the option, it's in the money. Period. Okay? Now, that intrinsic value is reflected in the price of the option dollar for dollar. In other words, if the price of the stock is at 35, right, that's $5 in the money, then the premium is going to be at least $5 plus any time value there may be. Okay? So, watch this. The investor buys an XYZ June 30 call at 2 when the stock is trading at 27. Now, fast forward, okay? Now we get into June, or whatever the expiration is. At expiration, okay? At or very near expiration. It's the last day of trading, okay? XYZ stock is now trading at $37 per share. What's the first thing you're thinking? Is the option in the money? Right? Is the market price of the stock greater than the strike price? Yes. So what do you think the investor's going to do now? Okay? I love asking that question. Every time I ask a question, okay, everybody sees, yeah, it's in the money. And I go, okay, what are they going to do? And the first thing somebody says, the first thing everybody thinks of out of their mouth is, oh, he's going to exercise. No, he's not. Remember? Why would I want to come up with $3,000 here? Why don't I simply sell my option on the exchange? Trade it. Okay? Why don't I simply trade my option? That's why they have exchanges, right? People can buy and sell their securities, just like stocks and bonds. Now, one thing is, oftentimes on the test, they don't say the investor trades his option. Oh, no, 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 no. How pedestrian, right? How simple. No, what if they said instead, the investor closes their position? I wonder how many of you have seen some of that terminology in your practice questions, right? So now you know what it means. It doesn't mean exercising. Okay. Now, theoretically, the third thing that could happen, you know, it's right at expiration. We're on the last day of trading. It could expire. But I don't think that's what this investor would want to do. Okay? So my question again is, if an investor buys an XYZ June 30 call at 2 when the stock is trading at 27. Then, at expiration with the stock at 37, what do you think the investor will do? Okay? The easiest would be to simply trade it. Right? The customer places a trade with their broker-dealer to sell their call option. Okay? Now, in a test question, that might look like this. The investor then closes their position. What is the profit or loss? Okay? Very simply, put it into a test question format, right? Okay? So, how do we solve this? Now, I'll tell you what. I wish there were 20 to 25 option calculation questions on the test. There aren't. Probably half, maybe. The others are typically suitability. Okay? And we'll get into those as well. Okay? But for the calculation questions, man, these are the easiest. I mean, the absolute easiest option questions. Because all you need to do, all you need to be sure that you do, is to simply track the flow of money into or out of the investor's account. Okay? In other words, just do a simple T-chart that tracks the flow of money out of or into the investor's account. That's all we need to do. Okay? So we're just tracking the buys and sells. Okay? So, investor buys an XYZ June 30 call at 2. Any money flowing? Sure. $200. Remember? Not $3,000. $200. Okay? Now, at expiration, with the stock trading at 37, the investor trades his option. He simply just sells that option contract. Okay? Now, how much will he get for it? That's the question. Well, what determines the value of any option contract, right? There's always two things, time and intrinsic. So all you got to do is determine those two things. Well, at expiration, how much time value is there? 0. Right? So I guess it all comes down to intrinsic value. Okay? Is the market price of a stock greater than the strike price? Yes. By how much? $7. Right? And we said intrinsic value is reflected in the value of the option, in the premium. So at this particular point in time, if I sold my option, how much would it be worth? $700. So we place a sell order, sell the option for $700. What's his net profit or loss? That's all there is to it. Okay? That's all there is to it. Notice how much the investor has out of pocket. $200. That's it. And he profited $500 from that $200 investment. Sure beats the heck out of putting up $3,000, doesn't it? See, again, it comes down to leverage. Okay? That's how we trade options. Really, the key to it is the option in the money at expiration, or at any time when they sell the option. Okay? So we're going to take a quick break here. We'll do a few more of these so we can get a better feel for them. We'll be right back. See you soon.